I welcome all of you to the Fundamentals of Anti-Money Laundering and Combating of Financing Terrorism webinar. This webinar is being conducted by MBL Consulting Private Limited. MBL Consulting is a BFSI domain consulting and training company. We support a large number of multinationals in BFSI sector, and we also offer various certification programs. This company has been in existence since 1996 and has been delivering sessions across the world. As far as I am concerned, my name is Makaran. I am in BFSI sector for last 30 years and I have been delivering trainings in various areas of banking, finance, business analysis, and also in fraud management. That is my background. Now, having understood the background of the company and having understood the background of the presenter, let us begin the discussion. Now, in this session today, what we will be discussing is what is money laundering, what is financing of terrorism, then we'll speak about the methods of money laundering, then we'll speak about the compliance standards and regulation, and we'll also talk about the use of technology for preventing laundering of money and combating the financing of terrorism. We'll end the session with our discussion first on what kind of reports are required to be filed by the concerned entities, and then we'll have the question and answer session. So this is the part which we are going to take today during our discussion. So let's begin the discussion on money laundering. I'll start with my first slide on the basics of money laundering. So let's first understand why people commit crime. And all of us understand that vast majority of many illegal acts are carried out mainly to achieve one simple objective. Everybody wants to have free source of money. So people commit crime because they want money. But then if they get this money, there is a problem associated with this. And the problem associated with this kind of black money or crime money is that they cannot spend this money easily or freely. Because the moment people who have committed the crime and have collected this money, the moment they start spending it, there could be tracking of that money, and somebody may raise this question that how did you earn this money which you are spending? And if they are unable to explain the source, it becomes difficult for them to spend the money. And second point, the money could be traced back to a crime and then they may be penalized for committing or having committed a crime. So when people commit crime, they will get money, but this money cannot be used easily, and therefore they need to have cleaning process for this kind of money. So let us understand what this cleaning process means. That is what we call as money laundering. So when you have dirty money, it comes from every kind of criminal activity on a global basis. And this kind of activities could be including drugs or illegal arms trading, illegal sex business, corruption, fraud, forgery, armed robberies, blackmail, extortion, frauds, and even trafficking in human beings. So when they generate this money, if the money is generated by crime, it is useless until the original intended source of fund can be disguised or preferably obliterated. Meaning, we should not be able to trace the money back to the crime. That is the basic objective of the party or the person who is trying to launder the money. He would like to have the money, but the money should appear as if the money is white money. That is the basic objective of laundering money. Now let us understand then what is money laundering. Money laundering involves taking criminal proceeds, that is crime money, and then disguising their illegal source in the anticipation of ultimately using this money to perform some legal and sometimes even illegal activities. So the basic idea is convert black to white. Convert this dirty money, make this dirty money look clean is the basic objective of money laundering. So when we carry out this process, we would like to disguise the true origin and the ownership of this money. We want to hide the crime, but at the same time enjoy the fruits of the crime. That is the basic objective of money laundering. Now when we have this laundering of money, don't go purely by the word money laundering. When it involves crime, it is not necessary that crime would always be performed to earn cash. It is possible that we get something else other than cash when we commit a crime. So somebody may be stealing a car, somebody may be even stealing wristwatches, somebody may be stealing a laptop, and then when they steal a watch, steal a laptop, they would still need to convert that into cash and then start laundering that money. So crime need not start every time by generating cash. Sometimes crime can start by generating some assets, some other items instead of cash. So we need to understand that money laundering need not involve only cash. It can involve laundering the proceeds of a crime and can include not only cash but other items like a stolen wristwatch or other items like stolen ornaments. So now when we have this wristwatch, we have these stolen ornaments, we need to convert that in such a way that ultimately what money we have in our hands, it appears to be white money. So to summarize, what money laundering means in simple terms would mean converting dirty money into clean money, into white money. Now what is the extent of problem which we face in this? And the extent of problem which we face in this money laundering is a large amount of problem. So the problem is very big. The World Bank and the International Monetary Fund estimate that the global laundering linked to corruption, criminal activity and tax evasion can constitute about 3 to 5% of the world's gross domestic product. So this is roughly between $2.17 trillion to $3.75 trillion a year. That means the amounts involved are quite huge, quite large. So the concept is that we need to stop this from happening, and the concept is that we need to identify this and then take steps to prevent laundering of money and also financing of terrorism. But at present I am speaking only on money laundering. I am not speaking on the financing of terrorism. We'll deal with that after a couple of slides. Now when we have money laundering being carried out, that is converting from black to white, we will have 3 basic steps. The first step is placement. Now placement takes the money one step away from the crime. So there could be many mechanisms of carrying out the placement. Now for example, if I have stolen a wristwatch, I would pawn that wristwatch, give that wristwatch as security to somebody and then take a loan against it. I may sell this wristwatch and then maybe generate money out of that. If I have stolen cash, I may deposit this cash in a bank and then be a little away from the crime. But then placement is only the first step. This step mainly involves introducing the illegal proceeds, that is crime money, into the financial system or converting that in some other kind of an asset. So as I said, I may put this wristwatch, pawn it to somebody else and generate cash out of that. I may sell the ornaments and then generate cash out of that, but then I am only one step away from the crime. So what I have accomplished is by placing the money or the ornament into circulation through some kind of a shop, some kind of a bank, some kind of a casino or some kind of a business, I have taken one step away from the crime. But this step is a dangerous step. Now why we are saying that this step is a dangerous step is because that if somebody still catches me while pawning the watch or while selling the ornaments or while depositing the cash in the bank, since only one step has taken between the crime and the placement, it is possible to trace it back immediately to the main crime. So at the most we are only one step away from the crime when the first step from the first stage of placement is carried out. So placement itself is not adequate. We need to take further steps and create more and more barriers, more and more obstacles between the main crime and the actual usage of money. And this we will achieve by carrying out the process of layering. In the process of layering, we will be creating more and more layers between the original transactions and the actual crime. This process is also sometimes called as agitation. It is also sometimes known as commingling. This involves converting the proceeds of crime into another form and creating complex layers of financial transactions to disguise the audit trail, the source and the ownership of the funds. So let us take an example. Now I have stolen some money, robbed some money. I may buy a second-hand car, and when I purchase the second-hand car, I have just carried out the process of placement because I am only one step away from the crime. So when I purchase the second-hand car, if somebody asks me a question, how did you get this second-hand car? then obviously I'll have to tell that this money came from crime. I robbed somebody yesterday. Then what I would then do to carry out the process of layering, maybe I will give this car as a security to somebody, and against this car I will take a loan. And then if somebody asks me how did I get the money, what I could say is I got this money, a loan, by giving my car as security. Now using this loan I may buy another asset, and like this I'll go on creating more and more number of transactions. And the moment I create more and more number of transactions, more and more number of layers, it would become difficult for anyone to trace that money back to the original crime which I have committed. So what we mean by layering is that we create more and more obstacle, more and more transactions, and many a times complex types of transactions, so that we build the big gap between the original crime and the subsequent transactions. And unless this stage of layering is completed, the criminal money may be placed in the banking system, but it could still be in one single block, meaning I cannot break this money. I need to break this money into various components, various transactions, and once that is done, I will be achieving the second step of layering. So to summarize on the second point, the second step, it is layering. So layering, we need to create more obstacles so that the trail does not lead to the original crime. This is the second part of money laundering. In the third part of money laundering, this is known as the integration. Now when integration happens, it gives the complete legitimacy to the money. The money appears now as if it is good money. So when at the integration stage, then it becomes very difficult for anyone to distinguish between the legal money and the illegal money. And this stage of integration provides the launderer the opportunity to increase his wealth by using the proceeds of the crime. So ultimately when the money arrives, at the other end of the pie, it will appear to be good money. So to summarize, we have three steps. Step number one, we have placement. Step number two is creating more and more obstacles, and that's what is called as layering. And step number three would be integrating that kind of money. And then ultimately after integration, post-integration, what will appear is white money. So black money gets converted through three steps: placement, layering, and integration into white money. Now having understood the three steps, we will be discussing the methodologies or typologies which are used to carry out the process. So we have three stages: placement, layering, and integration. Let us now understand the methods used to carry out the layering on the next slide. Now I may sometimes be using the banks to carry out the layering. So when we talk about the layering, I'll have the banks to carry out the layering. And in that process, when we use the banks to carry out layering, I could use different mechanisms. Now first step we said was placement. Let us understand how banks can be used to carry out the process of placement. I can have different accounts opened in the bank, and I will go on depositing small values, some values, into the bank accounts. Now this deposit would then appear to be the first step of placement. Now this sometimes is called as smurfing. Now what would smurfing mean? Smurfing would then mean the launderer would deposit small values into the bank account, not very large values, because the moment you deposit large values, it is likely to attract attraction of some party. So in order to avoid the attraction or attention to such large transactions, the launderer would start depositing small values. And in many countries, like in United States, the threshold for deposit of cash is $10,000. If you deposit more than $10,000 in your bank account in USA, a report is likely to be filed with the authorities. So in order to prevent this from happening, the launderer will deposit an amount which is a little below this threshold of $10,000. So let us say we deposit $9,000 into the bank account. So this will be called as smurfing, depositing a value just below the amount of the threshold defined by the regulator. Other way, I want to place the money and then I want to move the money very fast. I want to layer it. Layer it means move it from one account to other account. from one account to account 2, from account 2 to account 3, from account 3 to account 4, and across different banks. So what we would like to do while carrying out the layering is process the transactions from one bank to other bank, move the money from one bank to other bank, and we would like to do that in a very, very fast way. Now, if you want to do this in a very fast way, you could use the bank's payment systems like the real-time gross settlement system, the RTGS. We may use wire transfers, and when you carry out wire transfers, before anybody realizes, the money would move across multiple banks, and then tracing that money back to the original crime would become difficult. So using payment systems like the RTGS or payment systems like the demand drafts or wire transfers, it would become very easy for the launderer to move the money fast across from one bank to other bank, from one region to other region. And because of such electronic transfer facilities, the trail to the original crime would get lost. So while we place them in the accounts, we could use the wire transfers or the RTGS transfers for carrying out the process of layering. We also have the process of correspondent banking in many places. Now what we mean by a correspondent bank, that suppose you are a bank in a place like Germany and you have no presence in a country like Australia, you may partner with an Australian bank, and through the Australian bank your transactions would be carried out. Now this Australian bank would then be holding the account of the German bank, and all German bank's transactions in Australia would be routed through this Australian bank. Now this Australian bank would be purely dependent upon the risk management function at the German bank so far as the AML is concerned, the money laundering processes are concerned. If the German bank is unable to control the laundering of money at its location, then obviously the Australian bank would also get affected because it is servicing such a German bank which is not meeting with the requirements of money laundering. So banking system can be misused. The last point which I would like to make about this, in fact there are many more methodologies to use a bank. The last point I would like to make here is using the prepaid cards. In many countries you can purchase prepaid cards in an anonymous way. That means you don't need to have the know your customer compliance done. You don't need to provide any details and just purchase a prepaid cards. So a launderer of money can simply purchase such prepaid cards and then start moving the money, layering the money from one place to other place. Some countries earlier in Europe permitted you to have anonymous saving bank account. Anonymous saving bank account meaning that you are not required to give any name, you are not required to give any form, you are not required to give any address proofs or identity proofs, and you could open a bank account. This is what we are called as the Starbucks. So when you have the Starbucks, in a Starbucks account, you are not required to give any identity details. And if you are able to open such a bank account using such anonymous bank accounts, it would be possible for somebody to launder money. So to summarize, banks could be misused for laundering of money. Now let's take the next possibility. The next possibility is to use the money remitters and the money exchange houses. We call them as money service business. There could be various entities. At the airport you would have seen the exchange counters, or rather across countries you would have seen such exchange counters. Now in many places, in many countries in fact, there is a very weak governance, very weak inspection oversight mechanism of such businesses. So there have been instances where money has been deposited in foreign currency and has been converted into a different currency at a money service business. And since the money service businesses are not controlled very stringently in some parts of the world, in those locations it is again possible to misuse such money service businesses for laundering of money. Another favorite of the money launderers are the insurance companies. Now insurance companies do permit in some places purchasing the policies by making a cash deposit, and many of the insurance agents also are interested in meeting their targets because the commissions which the insurance agents get depend upon the amount of policies which they underwrite. So in insurance companies we may have some parties deposit cash and purchase the insurance policy. But then what would they do with this insurance policy? Many insurance companies and the regulations across the world have a concept of a free look period. Now what does free look period mean? Free look period means that during this period you can enjoy the policy, but before the end of such a free look period you could cancel the policy and get a full refund. Now let's take an example. Suppose in our country the free look period is 15 days. I would purchase a policy by paying cash, and then within a period of 15 days I would cancel that policy and get my entire money back. But when the insurance company gives me this money back, it is not going to give me cash. It is going to give me a check or an electronic fund transfer. Now when the money appears in my bank account, I could always explain this source as cancellation of policy, and the money has come through electronic means, which is likely to attract lesser attention. And even at the bank, if somebody looks at that transaction, they would simply think that either the insurance policy has refunded the premium amount or the insurance company has settled a claim. And then such a transaction coming in from an insurance company is unlikely to attract a lot of attention. So we could misuse the insurance companies by cancelling the policy during the free look period. The second way this could be done is overpay your insurance premium. Suppose your insurance premium is $500. Simply pay $800 of insurance premium. The insurance company is bound to refund the remaining amount, the excess amount of $300. But again, it will not do this by way of cash. It will refund the money by an electronic or a check transfer. So this $300 which somebody gets back is also money which could be explained. Many insurance companies allow you to take a loan against the insurance policies. So I could buy insurance policy in cash. This will be my step of placement. After having bought this insurance policy in cash, I would take a loan against this insurance policy by assigning the policy to somebody else. I have now taken this second step of layering. Now after I take this loan against my insurance policy, I may buy a car by taking that insurance policy. Then I will sell that car within a couple of days and then again carry out one more transaction using the proceeds of the sale of the car, and like this I would carry out the layering of the transaction. So we have insurance companies which could be misused. In addition to insurance companies, another kind of entities which could be used are the securities brokers and dealers. Now in many countries we have the concepts of the bearer bonds. You see an example on the screen. Now what is a bearer bond? A bearer bond can be simply handed or transferred by handing over the possession. Now I can go to some broker, purchase the bearer bonds by maybe paying cash, and then transfer the bearer bonds onwards to somebody else, get check or an electronic payment from that party. Again, I have carried out this step of layering. So in this way, even securities, brokers, dealers can be used to carry out the process of layering. Now having said this, let us go to the next step. We could also use some non-financial businesses and professions. Now in non-financial businesses and profession, a very simple thing to understand would be using the real estate business for laundering of money. You would have seen many countries where transactions in real estate, purchase and sale, happen partially by using white money and partially by using illegal money. So in such a case, if someone is buying a property, portion of the property cost, property price can be paid in other than the white money, by way of illegal money. And then again, by carrying out transactions in buying and selling such properties, you could be laundering money. Another way to operate is operate something like a hotel. So these people who have a lot of crime money, one thing we need to understand at this juncture is when people get this money out of a crime, they don't have any value for such money. Because they have not taken a lot of efforts. If I am accepting bribe, I am not making a lot of effort in earning that money. So that money which is earned through a crime has very limited or little value for those people who have earned it through the crime. And in this way then, they could go on buying properties at higher value. They could make investments at higher value because they have not made efforts in earning this money. So when they get this money, they would go on buying properties, they would go on buying hotels or many other businesses in which they would make this investment, and that is how again we carry out the process of the placement and the layering. So here we have an example of a hotel. we have already used this example of using the used cars. Another easy way of converting black into white is using the casinos and the gambling places. In fact, the Financial Action Task Force, which we'll deal with in a little while, has consistently noted the use of casinos in laundering money. In fact, it says that in most of the countries, many times they have observed that the casinos are used to launder the money. So how would you do it at a casino? Now at a casino, you will need to buy chips to play at the casino. So the chips could be sold in cash, and when you win anything, or maybe you lose something, you encash these chips, and you encash the chips by taking a check from the casino. So cash goes in to purchase the chips, and when the chips are surrendered, you get back check. One way. Second way, you win something, you would transfer these chips to some other country. Saying there could be casinos which are working across the world. They could be present in USA, they could be present in Europe, they could be present in Asia. So if you have some winnings in Asia, you could tell this casino that credit my account, I would use this money in United States. And then when you draw this money in United States, what you do is surrender the chips in USA and draw that money in form of cash. So what I would do is then, for example, I win in a country in Asia, but tell the casino to keep the winning with itself. When I go to United States, I'll encash that money from the same casino. This is how I will move money from one country to another country, and then it will become difficult for anyone to understand that the money has moved across the borders. The other kind of non-financial businesses and professions which are used include travel agencies. Now let's take an example. You book a Europe tour or an Antarctica tour by paying cash again, and then you cancel this tour and get a refund. Another way to launder the money. Another important area or important kind of activity about which the authorities are concerned are the gatekeepers. Now professionals like accountants, auditors, lawyers are called as gatekeepers. They are called as gatekeepers because they actually protect the people who may be committing crime. If you see a lawyer or an accountant, they may hold secrets belonging to such clients. They may hold money on behalf of such clients, and because of the confidentiality requirement in the professions, they will not be required to divulge the details of such transactions. So you would have noticed the concept of escrow accounts. An escrow account would mean a professional like an auditor or like a lawyer may hold the money on behalf of their client. Now when the lawyers or the accountants hold money on behalf of the client, they are not required to explain as to what money are they holding or why are they holding money, because of the professional confidentiality. Now in such a situation, if they start using that money, if they start spending that money on behalf of the money launderer, it would become difficult for the authorities to identify whether the money is crime money or the money is legal money. So this way, some professionals may act like gatekeepers and prevent us from identifying whether the money is legal and illegal, and thereby this would permit then those parties who want to carry out the laundering to carry out the laundering in an easier way. So we have non-financial businesses and professions which are used. In fact, we also use trade and trade activities to carry out such transactions in non-financial businesses. In trade, you could have under-invoicing done, over-invoicing done. There are concepts like cuckoo smurfing and black market peso exchange concepts, which are again used across the world to carry out laundering. Another favorite of the people who launder money and who would like to fund the terrorists is to use charitable trusts and non-profit organization. Now, let us take an example. I want to launder money. I have a lot of illegal money. That's the assumption. So when I have got this illegal money, I will start a charitable trust, a non-profit organization, and invite all of you to provide or give donations to me. What I'm going to tell you, that give me a donation of $100 by way of a check or by way of an electronic transfer, and what I would pay you back is $110 in cash. Now, when all of you give me a donation of $100 each in my books of accounts, this money is donations received from various donors. Whereas when I have this cash given back, there is no accounting done at all. It is all illegal money which I carry. So using such charitable trust, I will accept donations in legal way and give my illegal cash away. Now this donation which has come into my charitable trust is pure money. Now this is where this step of integration has taken place. If somebody now questions me as to how did you get this money, I can always tell that I have received donations from all these different parties. In many countries you will see political parties receiving donations. Now it's not difficult to guess the reason why they keep on accepting the donations. One more point to understand is it's not necessary that you run only a charitable organization. People may be running religious places. A religious place where we go, we never pay in form of card or a check or an electronic transfer. Most of the people, when they pay at a religious place, they would be paying in cash. So let us start a religious place. And I am collecting a lot of cash donations, offerings at this religious place. I mix my stolen cash with these offerings which the devotees have given. If somebody now asks me a question, how did you get so much of cash? My stock answer, my normal reply is many devotees come to my religious place. They give their offerings in form of cash. I am unable to identify each of them individually. So when somebody runs religious places, it is also possible to misuse them. I am not saying that everyone does that, but it is possible to misuse them to launder money. So this is another example where typology, methodology which could be used. Many a times people pay excess taxes and many countries accept tax payments by way of cash. The banks never question you when you make a tax payment as to why are you paying cash, because the cash is being given to the government. And if your liability is of $10,000, if you somehow deposit $15,000 in cash, nobody is going to question you. But at a later point of time, the government will assess your tax liability and provide you with a refund of $5,000. Now this refund of $5,000 can be explained very easily by saying I have simply got my tax refunds. If somebody questions me, this is the answer which I will have, that I got a tax refund. And using such kind of methodologies, we will be able to launder money. So we have discussed three steps. One, the placement. Second is the layering. And third is the integration. Now there could be many other products like a bank guarantee, a documentary letter of credit, which could also be used by the banking system to carry out the laundering of money. So these are the examples, methods which are used for laundering of the money. Now I will start discussion. We have understood what is money laundering by now. I hope so. Now let's look at terrorist financing. Now terrorist financing is a completely different concept as compared with laundering of money. And terrorist financing consists of two basic activities. One is raising money for the terrorists and then funding the terrorist activities. So terrorism financing actually refers to activities that provides financing or financial supports either to individual terrorists or to terrorist groups. So this, as we said, involves two activities. It encompasses the financing of operational cells. That means there could be terrorist cells. We need to fund them for their living expenses, funds to plan for and train for and for commitment of terrorist act. There is also this process of raising money. And then the money could be raised internally meaning they may carry out some activities like maybe hijacks or maybe some robberies and some other activity using which they will be, or maybe kidnapping, and using such activities they will generate money. So the fundraising by terrorists can be done by them on their own by committing some other crime. And secondly, there could be many well-wishers, many people who support such activities, and then the money could be generated through donations or charities. The money could also be generated by carrying out financial business activities. There have been instances in the past where the terrorists have operated front companies. They have carried out trading activities, business activities, and these business activities have generated money for the terrorists. So these are the ways the terrorists could raise the money. Let me summarize the three ways the terrorists would raise the money. Number one, carry out some crime like kidnapping or hijacking or maybe robberies. Number 2, run businesses. The terrorist may run a business or maybe charities. And then third way is to accept donations from the well-wishers. The well-wishers could be governments themselves. The well-wishers could be individual entities. So this is how terrorist financing would be looked at. Now let us compare money laundering with terrorist financing. Though not identical, they are all different. Though many regulations and laws which are created talk simultaneously about laundering of money and also financing of terrorism, they are conceptually different. Money laundering is the process, as we saw, where the cash used or raised from criminal activities is converted into legitimate activity so that the launderer can use it himself. Whereas terrorism, it does not care about the source of the money but the use of the money. So let us understand that money laundering is a circular path. If I have committed a crime, I would launder that money because I want that money back for my own use. So it goes away from me, moves a certain path in a circular way and comes back to me only through 3 steps: placement, learning and integration. And in integration, I get my own money back. But when we speak about terrorist funding, it is one-way street. It is a straight line. Money will go away from me and then it will never come back to me. So when you look at money laundering, it is a circular path. When you look at the terrorist financing, it is a one-way, a singular path. It's not a circular path. So when we talk of money laundering, there could be, and the terrorist financing, there could be other factors also which could be used for distinction. Now, when you launder money, the value of money being laundered, the amount of money which you launder will be very high. Now, I would not launder $50. I may be laundering $500,000, a large value. But when a terrorist raises money, the amount of donation which a terrorist receives may be even $5. Which means in money laundering, the transaction values are going to be huge in most of the cases, whereas in terrorist funding, the transaction value could be small value, the transaction value could be a very large value. This is one difference. Second point, when we launder money, the money is created by committing a crime. But when a terrorist is being funded, it's not necessary that the money is generated by committing crime. We looked at 3 sources. We said that the source could be crime, second source could be a business activity, the third source could be donations. Now the last 2 sources, that is a legal business activity whose money is being used for funding the terrorist, or a donation, did not come from illegal sources. So the second point differentiating money laundering with terrorist funding is money laundering will have illegal beginning. The terrorist funding need not have the money which comes only from criminal source. That is the second type. The third type, or the third difference, is when we launder money, we will always do it through official channels. That is because at the end we want that money to appear to be legal money. So it has to be a produce of a legal payment system. But when we want to fund the terrorist, we are not going to use the official channels in most of the times. We may use some mules, that is individual carriers carrying cash, or we may use a system like a Hawala system. So when we pay the terrorist, we may be using illegal channels to make such payment. So to summarize, money laundering starts with a crime but tries to reach the legal end. So the end has to be legal. Whereas terrorist funding may start from legal side, legal means, but end in a crime. That is how money laundering and terrorist funding would differ. I believe now we have understood the concepts of what is laundering money and what is financing of terrorism. We have also understood what is the difference between both of them. Now, having understood this, let us understand why are we learning this. Now, we are learning this not for laundering money or not for funding a terrorist. We are learning this for prevention and detection of these activities. That is the basic objective of our discussion today. Now let's understand the impacts. What we are trying to do is find out a wolf in sheep's clothing. That is what we are trying to do here, because they will be wearing different garbs and they will be hiding behind some of the screens, we need to pierce that screen, we need to break that screen and identify. Now, why is it necessary to identify and prevent the money laundering? Let me take that point. Talking about are the impacts of money laundering and terrorist financing. Now, money laundering and terrorist financing can have potentially devastating economic, security and social impacts. Let us understand each of them. Now, we said people would like to launder money because they have some crime money. Now, just imagine a scenario that in a country, it is quite easy to launder money. The first impact on that country is going to be those criminals who have illegal money will go to that country and start laundering money in that country, because that is a haven where you could launder money. So laundering money would become possible in such countries. If laundering becomes possible in certain countries, then more and more criminals will start going to that country and the crime rate in that country is likely to increase. And along with the crime rate, the corruption in that country would also increase, because that country permits laundering of money. So the first impact which will have, if you permit laundering of money, is your country will invite more and more criminals, and then more and more corruption will increase. That is the problem number one with laundering of money. Secondly, as we said a little while ago, those who have this illegal money have no value for that money. They have not spent any amount of money. Hard work has not been done to earn that money. They are least bothered about the money value. So what they would start doing is they would start spending money left and right into that economy. They would start buying things by paying higher prices. One impact of this would be the price levels in such countries would increase, because people now have free source of money and they spend this money freely. It could impact the inflation in that country. The legitimate businesses in those countries would also suffer. Let us take an example to understand this. Suppose there is a genuine person running a hotel and somebody else who has got illegal money purchases another hotel just next to this legal hotel. This new illegal hotel can afford to give lower rates, cheaper rates, and they are willing to make a loss, because whatever money has been invested in this illegal hotel, the owner does not have any value. He is anyway having free source of the money. Then the legal hotel would get affected, because the prices could come down, because he is competing with somebody who has got n amount of money, unlimited amount of money without any cost, whereas the legal hotel would have money borrowed, it would have certain cost, and it would be complying with the regulation. So such legal businesses, legally operated businesses, legitimate businesses would start suffering, because such illegal entrepreneurs will enter into that business and then bring the legal business down on its knees. So it affects and weakens the legitimate business entities, because the illegal businesses have completely free and unlimited supply of money, which the legal businesses do not have. It also impacts the economies. In fact, in some of the South American and some of the African countries, the terrorists and the money launderers have bigger budgets than the governments themselves in such countries. In such a case, the economies are taken over by such people who launder money. Again, people who do not pay taxes because they have free money, illegal money, it impacts the tax rates of all those genuine people who are paying taxes legitimately. This also results into loss of tax revenues and increases in the tax rates. It ultimately affects the reputation of the country. And last point, it also has issues related to social costs. Now, in a country where money laundering and terrorist financing is happening left and right, in such a country, since people have free source of money, there are many young generations which would go haywire. They will start using drugs, consuming liquor, and because of this, they will get addicted to drugs and liquor. That is one social problem, because there is free, easy money available. Second problem, because of this, the unemployment rate increases. Because of this, the law and order costs also increase, because there is more crime. You need to spend more on law and order. And third, is that because of such abuse of drugs, use of liquor, the health costs in those countries also increase. So the social cost which a country has to pay if it permits such laundering of money is increase in the drug addictions, increase in the related health cost, and increase in the related law and order maintenance cost. So these are the impacts of money laundering, and therefore most of the countries do not want to have such money laundering and funding of terrorists in those countries. It affects those countries very badly. So then what is the solution? Who would drive this response? The biggest driver of the response is the Financial Action Task Force, the FATF. Now FATF is an intergovernmental body. That means many governments are a part of the Financial Action Task Force. In fact, in response to the mounting concern over money laundering, the Financial Action Task Force on Money Laundering was established by the G7 Summit in 1989 at Paris. It was earlier called the G7 Financial Action Task Force. It was renamed as the Financial Action Task Force. This intergovernmental body is based at the Organization for Economic Cooperation and Development's office in Paris, where the FATF has a small secretariat. Now FATF has 40 recommendations, 40 normal recommendations, revised recommendations, and 9 special recommendations which are recognized by the International Monetary Fund and across the world as standards for combating money laundering and the financing of terrorism. These 40 recommendations are used in many countries, including United States, including in India. So these are, then we have the FATF as one of the major players. In addition to FATF, we also have the Basel Committee on Banking Supervision, the BCBS. Now BCBS is a part of the Bank for International Settlement. The Basel Committee on Banking Supervision has issued various guidelines for the banking industry on how to prevent laundering of money and how to prevent the funding of terrorism. For example, they have a prevention of criminal use of the banking system for purpose of money laundering, a guidance issued by them. They also have issued a guidance note called Sound Management of Risks related to money laundering and financing of terrorism. Of course, they also drive the KYC norms, the customer due diligence for banks, and also the consolidated KYC risk management. So second bigger player across the globe in the banking industry is the Basel Committee on Banking Supervision. Now we have regional leaders also. One of the regional leaders is the European Union, the Council of the European Union. Now the European Union actually came out with its fourth directive last year, that is in 2015, about the prevention of laundering of money. This directive, which is issued by the European Union, applies to a range of businesses. So one thing we need to remember at this point, that even when we speak about FATF or the European Union directives, they do not apply only to the banking system. They apply to all businesses and professions, irrespective of whether they are banking businesses or non-banking businesses. So the regulations of, for example, FATF are to be complied by a financial institution or even a non-financial business and even a profession. So it's not necessary that we look only at the banking system for the compliance. The compliance has to be done by everybody who is going to handle activities on behalf of a customer. So a professional would be involved, a non-bank entity would be involved, and even the banking entity and the financial entities would be involved in the compliance. The other group created by the banking system in some of the places is the Wolfsburg group. But before we talk about that, let's speak about the Office of the Foreign Asset Control, the OFAC. The OFAC, the Office of Foreign Asset Control, is the arm of the United States Treasury. Now this arm of the United States Treasury declares many entities as specially designated nationals, SDN. OFAC has an SDN list. OFAC also has a list of certain countries against which the United States has declared sanctions. In case you do not comply with the OFAC requirement, the penalties are very huge, and in addition to the financial penalties, there is also imprisonment involved if the OFAC compliance is not done. OFAC produces the list which is aptly used by OFAC across the world. That is the Office of Foreign Asset Control, which is, as I said, is a part of the US Department of Treasury. The other one, the next one, is the Wolfsburg Group. 11 banks from different parts of the world came together and that includes various banks, as you can see on the screen. They created their guideline as to how we should prevent the laundering of money. In fact, they have guidelines for know your customer, anti-money laundering, and also counter-terrorism financing policies. This group is a group created by 11 global banks, and it aims to develop financial services industry standard and related products for KYC, for AML and CFT. This group was formed in year 2000 in northeastern Switzerland. So this is another major player, and the banks which you see on the screen are major banks, global banks working across the world. So any bank, any entity dealing through these banks, the bank would then need to ensure that the Wolfsburg compliance is carried out. We also have the Egmont Group. Now Egmont Group is a group created by the Financial Intelligence Unit. Egmont Palace is in Brussels in Belgium, and the Financial Intelligence Units decided to come together and establish an informal network of the FIUs, the Financial Intelligence Units, for the stimulation of international cooperation. The basic idea, the basic goal of Egmont Group is to provide a forum for the financial intelligence units around the world to improve the cooperation in fight against laundering of money and also the financing of terrorism. And then using this concept, they exchange use cases, they exchange sanitized cases. In fact, any of you, if you are interested in understanding how money is laundered or financing of terrorism is done, you could visit the website of Egmont Group, on which you may get a lot of information about the real cases, real sanitized cases as to how money is laundered. So this is the next biggest player. In fact, in addition to this, most of the governments across the world are also involved in ensuring that money laundering or funding of terrorism does not happen. So this is our drivers. These are our drivers who drive the response across the world. Now, having understood who are the drivers, what are they driving at? What are they prescribing? Now, the drivers then prescribe various guidance and regulations. I have been speaking about the FATF regulation. So FATF has got these standards, international standards on combating money laundering and the financing of terrorism and the proliferation of such activities. It has also provided the methodology for assessing technical compliance with the FATF recommendations. So those who are in a country which is a signatory to FATF requirements, they will need to ensure that the FATF recommendations and the methodology are implemented. Like FATF, we discussed the EU Fourth Directive. The OFAC would have its own guidance. Many countries, many central banks, many supervisors in the banking industry, many supervisors of the insurance industry have also come out with the guidance as to how should we detect and prevent laundering of money and funding of terrorism. You can also think of visiting the website of United Nations Office on Drugs and Crime, where you will get a beautiful document titled Risk of Money Laundering Through Financial Instruments. If you have a look at this document, you will get complete process product wise. For example, saving banks, current accounts, loan accounts, how should we identify whether these accounts are being misused to launder money. So these are some of the prescriptions which are available. Now, what do the prescriptions across the world ultimately say? They say that every institution, irrespective of whether it is a financial institution or a non-financial institution or a business or a profession, they must have an AML and a CFT compliance program. What is then required under the program? What we need, we always say this, that prevention is better than cure. So it is obviously better to prevent illicit funds from entering the financial system or the business systems than chasing them after they have entered into the system. And for this, we'll have to have a robust AML program at each of the financial institutions, insurance companies, businesses and professional. And then what would such a program include? The program would then include customer due diligence mechanisms, including those for new customers, including those for existing customers. And in this due diligence program for prospective and existing customers, we need to have the process of customer profiling and the risk assessment. That is at the entry level. And once they have entered into your system, we should also have transaction monitoring systems. How are the customers acting, how are the customers behaving, we need to have the monitoring systems. And if we find any suspicious, atypical, a different type, an outlying transaction or a different customer behavior, we should be able to detect that as well. And for this we may sometimes need usage of software or software applications or software systems. So ultimately what we need to do is have an AML and a CFT compliance program wherein a risk-based approach is required to be taken by the institutions concerned. Then what do we mean by a risk-based approach? We need to assess three things when we look at the risk-based approach. What are these three things? One is which kind of customers are we going to service and what kind of risk do they give to the organization from the perspective of misusing the institution for either laundering of money or from the perspective of funding the terrorists. So we need to look at the customer types. So risk-based approach would require us to look at the contributors to the risk. One of the contributors to the risk will be your customers. Second contributor to the risk would be the products which these customers use. And the third contributor to this risk will be the kind of processes used by the organization to service such customers in respect of the products selected by the customers. So you've got three-pronged approach from risk management angle. Three prongs are the customer risk management, the product risk management, and the process risk management. Now all these three risk management approaches are from the perspective that whether it is likely to harm the institution from money laundering angle or financing of terrorist angle. We are not looking at the risk, let us say, from the angle of credit risk or market risk. We are looking at them from money laundering related risk and from the financing of terrorism related risk. So how would we do this? Suppose we have a customer. How do we understand whether a customer would constitute risk? So we need to have customer demography. Now a customer may be coming from a country which is an NCCT country. Now what is NCCT? NCCT is non-cooperating country and territory. So he may be coming from a country which does not intend to comply with your money laundering regulation. Then you need to look more at such a customer. You may have a customer coming in from a country which is in the OFAC sanctioned countries list. Then again we need to look at this customer from a different angle. Again, within a customer from a country, you could have different risks involved. There could be a customer who is a medical doctor. There could be a customer who is a lawyer. There could be a customer who is a professional pilot. There could be another customer who is a politician. Now when you look at the risk of each of them and the possibility of some of them misusing this system, you can identify the risk on your own based on the customer types. You can also look at the customer constitution, meaning is he an individual? Is it a trust or a charitable organization the way we discussed it earlier? Or is it a casino? Or is it a corporate behind whom many terrorists or many launderers of money can hide? So we need to look at the structure of the organization, the constitution of the customer, an individual, a partnership firm, a charitable trust, a corporate. All these would give you different risks. Now I'm still on the customer related risk. Then you could also have the kind of relationships involved while you carry out the transaction. We spoke a little while ago about the correspondent banking. Now there could be a customer of your bank where you are serving as a correspondent. Let us imagine that I am Bank A, I am a correspondent of Bank B and I am processing money at Bank A on behalf of a client of Bank B. Then Bank A needs to be more careful because it is not having its own customer, own direct customer. It is dealing with some other bank's customer because they are correspondents of another bank called Bank B. So when the customer belongs to some other bank and then I am processing a transaction on behalf of another particular bank, then I need to be more careful. So this is how when you look at the customer risk, we will look at various angles. We could similarly look at the product risk. As I said a little while ago, there could be products like the documentary letters of credit. Now in a documentary letter of credit, what is required by a banker is only a set of documents. We do not really go into the genuineness of the products which are supplied during a trade transaction. For example, somebody may be importing and exporting iron bars. Some may be importing and exporting something like maybe cement. In such a situation, what the banker does is only looks at the documents and he does not really look into the commodities which are being transacted. And then to create a document, it is quite simple and easy to do that. So in case of certain products like a letter of credit, a bank guarantee, some products like private banking where there is a lot of secrecy involved, such products, even products like prepaid cards, products like investment banking, investment management, and then product channels like remote channel, like an internet banking channel or a mobile banking channel, where we are not able to really understand whether the customer is carrying out the transaction or not. In such a case, we need to be careful about the product related risk. So when we take this risk-based approach, we need to identify what kind of risk your customer, your products, and your processes will create, and then take appropriate steps to mitigate those risks emanating from all the three types. So the first component which we are now moving to is the KYC, the Know Your Customer norm, also popularly known as the CDD, the Customer Due Diligence. So now, whether the profits of a crime, like we talked about money laundering, the first step of placement is the most dangerous step for any criminal, because if the criminal is caught at that point of time, at the stage of placement, the crime can immediately come to light, because there is only one link between the crime and the placement stage. So the efforts are made by authorities most of the time to capture a customer at the time of opening an account or creating a relationship with the bank, because that is the place where placements could start. And if you are able to identify an illegal activity at the level of placement itself, then the entire subsequent process of layering and integration would not happen. And since there is a direct connection between placement and opening of accounts in most of the cases, most of the regulations and training to AML is focused on the account opening procedures, that is the KYC norm. So what would be involved in KYC norms? We may have a customer acceptance program, we may have customer identification policy, then we do CDD. So step one, have a customer acceptance policy. Every institution will decide what kind of customers are acceptable to them. Having decided what kind of customers are acceptable to us, we now need to check each and every customer, a prospective one and an existing one. We will ask them for the documentation. We may ask them for their identity proof. We may ask them for the address proofs, various other things, just to know whether the customer which is approaching the bank falls into the category of acceptable customer. So step one is create the acceptance norms, then check each of the incoming customer or an existing customer against the norm by using certain set of documentations. Once you are satisfied that this customer is an acceptable type of customer, then the next step will be carry out the risk profiling of the customer. We will create profiles. Is this a low risk customer, a medium risk customer, or a high risk customer, depending upon the possibility of the customer misusing the organization to launder money or to fund terrorists. And then you could look again at the customer demographics. A customer who is a non-resident, a customer who is from a country which is in the banned entity list is likely to be more risky as compared to the customer who is from a whitelisted country. A customer whose profession is like a criminal and whose profession is maybe like a professor in a college, the professor is likely to be less risky. So in this way, we will need to classify the customer and profile the customer into low, medium, high, and of course unacceptable risk. We will not open any account for those who are unacceptable, and then open accounts only for those who are acceptable. And this processes will be applied for all new customers. We will run the same procedure periodically for our existing customers under our continuing KYC program. And if we find that any of the existing customers do not meet our norm now, we will apply the exit procedures to them. So this is how we will carry out the customer due diligence. In some cases, enhanced intensive due diligence has to be done. Banks will use the word enhanced due diligence, EDD. Now we may do this in case we find that the customer is a politically exposed customer, PEP, having links with some political party, or a reputationally exposed customer, an REP, or maybe a customer which is a trust, a charity, a non-government organization. We may do extra diligence process in respect of such customer. Step number one then will be customer due diligence. The second major component of this process is the customer monitoring program. we continuously monitor the activities of the program. We may run applications. We will use many applications are available from various reputed software companies, which will give you the process of monitoring the customer transaction. Now the customer monitoring can be done in two ways. Real-time monitoring, meaning when the transaction is actually happening, instantaneously capture the transaction and carry out validation of the transaction. And second is post facto. That means after the transaction has been done, carry out the analysis by taking the data dump. Then this would not be real-time monitoring. Real-time monitoring is done at the transaction level, and usually when we do post facto or data dump analysis, enables us to find out trends. And this is because if you look at one single transaction, it will not throw up any trends. But when you pick up a set of transactions or database of transactions, we'll then be able to understand the patterns. Patterns will emerge, the trends will emerge, and then using the patterns and the trends, we'll be able to identify the outliers, and such outliers will be taken up for processing or for analysis to understand whether they are transactions which are laundering of money transactions or transactions which are likely to be suspected transactions of funding the terrorists. And to do this monitoring, we may apply different mechanisms. We can have transaction filters. For example, we can take a transaction filter that find out all transactions above the amount of $10,000 and then analyze those transactions. We could do rules engine. Let's take an example of rule. I said a little while ago that if you deposit cash in United States about $10,000, I will be reported to the authorities. In India, if I deposit more than 10 lakhs of rupees, that is 1 million rupees in cash in a bank, I would get reported. So those who understand these thresholds may deposit a little less. So for example, we said in USA, I may deposit $9,500. In such a situation, I can build a program in my application saying that identify all such parties who have deposited just between $9,999 maybe up to $7,000, and this list then generated by the application would throw me the possible parties who are carrying out smurfing, that is depositing little below the threshold. Now once this is being done, people will understand, those who launder money will also understand that the bank generates a list of all such parties between 9,999 and 7,000. People would then start depositing still smaller amounts. And then they may ask their friends, relatives, those who are neighbors to deposit, or maybe their peers in the company to deposit a part of cash in their accounts. This is where we may use the text mining or link analysis. Now using text mining, we would like to identify whether these entities who are depositing cash in a bank, do they have any relationship? Do they stay in the same building? Do they work in the same office? Do they have similar names, same last name? And if we run this program, this mining program, we'll be able to identify where people are creating groups and then depositing money or carrying out the activity of laundering money or funding terrorists. This is how text mining will work, and a link analysis will also work. So one mechanism will be rules engines, and then doing text mining and doing the link analysis. We may also create neural networks, that is artificial intelligence. Based on our historical experience, we will build a template of transactions which look like money laundering transactions. Now an identical example could be using the antivirus on your machine. Now whenever your antivirus application is on, it compares the signatures, existing signatures, with the data set which is available in the machine, and then finds out whether they match. If it matches, it says that this is a particular kind of virus your machine is carrying. In a similar way, like a virus signature is created, you could create a signature of money laundering transactions or terrorist funding transactions, and then compare the transactions or a set of transactions against this template, and then throw up an alert to identify whether it is laundering of money or funding of terrorists. We could also have profiling done in respect of customers. How would profiling work? Let's take an example. Now you look at my saving bank account. You understand that this person gets a monthly salary of $2,000. He usually spends around $1,300 on various items. He withdraws cash to the extent of $300 to $400 every month, and the balance remains in his account. This is the profile created in respect of a saving bank customer. And now you suddenly start finding large debits and large credits in this account which are not in line with his usual activity. So you find that there is a mismatch in the profile. Usually the customer used to have credits of $2,000-$3,000. Suddenly $20,000, $25,000, $50,000 have started coming into the account, and a lot of money is getting withdrawn from the account. You know that there is something incorrect happening in this account. You could also check the velocity of the transactions. Let me explain what I mean by velocity. Now when I want to layer money, I would move the money from account number 1 to account number 2, from account number 2 to account number 3, from 3 to 4, and like that continuously onwards till it gets integrated into the system. In this case, the feature of all these accounts which are in between the pipeline accounts should be that there would not be much difference in the opening and closing balances in these accounts, but the debits and credits in these accounts would be substantial. Now if you find an account where there is not much of a difference in the opening and the closing balances, but a lot of debits and credits have gone in that account during the day, if you pick up a list of such accounts are a target to identify the pipeline accounts which are being used to move the money from one end to other end. In this way, we use the CDD as the first filter, KYC as the first filter. Why I'm calling it as a first filter is because we want to prevent the people from entering into our financial institution, from entering into our enterprise. And the second reason I'm calling the second one as the second filter is because they may jump the first filter of KYC and be within your organization. If you want to prevent them from misusing your organization, you must monitor their activities. That is what is called as the customer monitoring program. So you'll have two major components, two main filters. One is KYC and the CDD, and second is the customer monitoring program. So what we need to monitor is suspicious or unusual transactions, and then the last step would be to report the transaction. We already spoke about the usage of technology, because for a human being it would be quite difficult to carry out this transaction analysis. Let me explain why we are saying that technology creates the problem and solves the problem for us. Technology creates the problem. Let me first explain this. This is because nowadays, especially in banks, the transactions happen at a single location through the core banking solution. In the olden days, every branch would have its own set of books, and the branch would do its own accounting, and then the branch would understand the branch level transactions. But today, with the data center concept and the core banking concept, all transactions happen at a single location. The other people in the bank are not able to understand what is happening at this single location. It happens very fast and it happens at one single location. This is one issue because of technology. Second is the remote channels. Earlier, maybe go back 15-20 years ago, the customer had only one channel called branch. The banker would then know the customer and the customer would know the banker, because both of them will be interacting with each other at the branch. But today, with remote channels like internet banking, like an ATM, like mobile banking, you are not allowing the customer to come to the bank, and because of this, the gap between the customer and the banker has become wide. Today, the banker does not know the customer and the customer does not know the banker. Again, a creation of technology. But having blamed the technology, I will also say that we need to use technology, and then various rule engines, various neural networks, various mechanisms like text mining, outlier detection, link analysis, rule patterns, sequencing will all be possible only with technology. So don't think that technology is a bane, it's a boon which we have, and we need to look at technology from that angle, and from that perspective only industry keeps on using applications across the channels, across the business verticals to check the laundering of money and to check the prevention, to control the financing of terrorists. Now once we understand and identify such alerts based on the usage of applications, then what we need to do is carry out the reporting. A financial institution's or a business's role ends when they submit a report to the appropriate authority. Across the world, you would have various financial intelligence units. In the United States, we have the Financial Crimes Enforcement Network. Once you identify a transaction, then you need to investigate that transaction, and after having investigated that transaction, we need to report the transaction to the appropriate authorities in case the institution is not satisfied with the response or the reasoning given by the customer in respect of such transactions. Now, what kind of reports then we file in case the institution is not happy with the kind of transactions? There are two kinds of reports to be filed, especially the cash or the currency transaction report, the CTR. As we said, in USA, if the amount is about $10,000, or in India, if the amount is about 1 million rupees, Indian rupees, we need to file a report with the authorities. This is point one, kind of first report. The second kind of report is the suspicious activity report, the SAR. Now, what is suspicious is not defined in the regulation. Anything which you find suspicious, not in line with the usual profile of the customer, not in line with the usual business activity of the customer, not in line with the usual activity in that particular region or that particular line of business, then we need to create a report and file the suspicious activity report with the appropriate authorities. Once the institutions have filed the CTR or the SAR as may be applicable, then the role of the institutions is over. This is at this stage then the authorities will take over from the institutions and then they will carry out the process of investigation. So this in nutshell is the process of reporting. Now let me summarize before we go ahead with our questions what we have discussed so far. Now what we have discussed so far is what is the meaning of money laundering. Then we looked at various typologies of money laundering. Then we looked at what is financing of terrorism, and then we differentiated money laundering from the financing of terrorism. We then talked about who are all interested in controlling this, starting with the Financial Action Task Force, the Office of Foreign Asset Control, the European Council. Then we also spoke about the Wolfsburg Group. Then we discussed the impact this would have on the economy of a country and also across the world if we allow this money laundering and terrorist funding to happen. We spoke about the social impact, the political impact, and the financial impacts of this. Then we looked at the mechanisms to identify them. We spoke about two processes. One is customer due diligence and the know your customer. And second, we talked about the monitoring of activities of the customer. Then after having monitored the activities, we talked about carrying out the reporting, that is CTR and the SAR. Now with this, I now come to a conclusion of our discussion on the fundamentals of money laundering and the fundamentals of prevention of financing of terrorism. Now at this level, if you have any questions for me, I am now ready for your question. Now we have a question from Mallikarjun. That is, if the bank does not follow these rules. Let me tell you the process. If the bank does not follow these rules, then depending upon the kind of problem. Now the problem could be in the field, Mallikarjun, in the field of money laundering. The problem could be in the field of our funding of terrorism. The problem with AML and CFT compliance for the bankers is that in other non-compliances, for example, a bank breaks a law in respect of, let us say, lending of money, the bank would get penalized. But in case of AML and CFT compliance failures, the bank and the banker personally would get penalized. This would involve financial penalties. This could involve cancellation of licenses. In fact, in United States, there have been cases where the bank's licenses have been cancelled. In addition to the financial penalties and cancellation of banking licenses, there have been instances where the bankers have been put into prison for failing to comply with the regulation. So three implications. One, there will be financial penalties. Two, there could be restrictions on operations and cancellation of banking licenses. And three, there could be imprisonment for all the concerned officials who failed to meet their obligations. These, Mallikarjun, are the implications in case a bank does not follow the rules. Okay. Now the next question is from Sandhya. Are all organizations, that is NGOs, NPOs, private public trusts, are required to follow AML guidelines? The answer is yes. The FATF requirement, Sandhya, is that everybody, that is banks, financial institutions, all non-financial businesses and professions. In fact, many institutions like the Institution of Chartered Accountants, the bar associations of lawyers have also started asking their members to start compliance with the AML and the CFT process. This is mandatory for all businesses, including banks. So NGOs, NPOs, private, public trust, everybody must comply. But then this compliance could become a problem. Everywhere getting your KYC done would become a problem, and therefore we have these schemes like the social security number in the United States, or the schemes like the Aadhaar card in India, where you get KYC done only once and that KYC is acceptable to all of them. So you could have a centralized KYC compliance done to overcome such issues. Sandhya, are we clear? Sandhya? Okay, next point is from Tuhin. Tuhin, the difference between NCCT and sanctioned country. NCCTs, non-cooperating countries and territories, do not believe in your regulation. They are not signatories to FATF. They don't want to comply with these laws. So there could be some countries which have not signed the FATF agreement, whereas sanctioned countries agree to comply with the law, but there are political issues between two countries. For example, United States may have a difference of opinion with a country like Libya or like a country like Iran. In that case, country-specific sanctions will get created, or at the United Nations, sanctions will get created, but these are mainly from political angle. So sanctioned countries have other reason than money laundering, because of which they get the sanctions, whereas NCCTs do not believe in your regulation of money laundering. Are we clear about the difference? The sanctioned ones believe, but there is a political. We're going to the next question from Anupam. When we have Federal Reserve, which acts as a regulatory body for banks in USA, then why do we have OCC looking into domestic banks when it is already being done by Federal Reserve? In fact, your question itself has the answer, Anupam. In United States, there is a layer of regulators. The Federal Reserve's role is basically to look at the international banks and the financial industry. Whereas OCC, where even the Office of Thrift Supervision, the OTS, has been merged, their role is to look at the industry which is operating within the United States, that is domestic banks. So the role of Fed is to govern global American banks, number one. Two, to govern foreign banks operating in United States. And three, look at the financial industry from financial stability perspective. These are the three important roles of Federal Reserve. Their role currently does not involve looking into domestic banks and looking at the banks which are earlier falling under the supervision of the Office of Thrift Supervision. That role has been given to OCC. Now, having said this, you will still find a cooperation between Fed and the OCC, and a separate group has been created to create the coordination among different regulators. You should have added one more regulator which is present in USA, rather two. One is the Federal Deposit Insurance Corporation, Anupam, which will start regulating the banks if insurance is taken from them. One more is the National Credit Union Administration for credit unions. So you will have basically four regulators looking at different sectors: the Fed, the OCC, the National Credit Union Association Administration, and the fourth one is the FDIC. And there is a coordinating body where all these four regulators need to act in synchronization. For that, there is a presidential group created. So all four work in different directions, coordinated by the presidential group. So friends, now it's time. I would like to thank all of you for participating in the session. What I'll be doing is sharing the PPT with the participants. We'll also put up this edited recording on YouTube for you to download. So thanks a lot. Enjoy your rest of the day.